Is the free market system ending? Trump criticizes Powell for interest rates. What's up, everybody? Welcome aboard to Bubba's Bottom Line. Todd, Bubba Hort with you. And of course, it is Sunday, March the 3rd, and Friday's action as March came flying in. We had a huge upstart. Markets broke off and then ended up higher on the day, making it, I believe, the 10th or 11th week in a row of upward closes. A lot of things to talk about the action, but I think first thing to look at is as President Trump spoke at the conservative convention over the weekend, massively criticized Chair Powell about the interest rates and the U.S. dollar. And I guess the big question here is, okay, if we're going to criticize China for manipulating currency, yet we want to manipulate currency, I think that's an issue. And again, look, the one thing I know for sure is that all major economies try to manipulate their currencies. I don't understand why, but I thought the fiat currency model was supposed to be fair and free markets, but apparently we have to all, as you watch Mario Draghi, as you watch the Chinese, as you watch the Japanese, everybody wants to manipulate their currency to zero, kind of like, making the dollars in your pocket worth less money. But I think that this is where the real problem comes in, is the destruction of the free market system. This is, where we have true price discovery and a true model, which we are not getting right now, okay? If you're going to have to try to manipulate to get the economy working right, because the economy itself can handle higher interest rates. The economy itself, if we are surging, which it looks like we are, I mean, we're at full employment, okay? We've got higher paying jobs. Again, the jobs are well behind in paying than the stock market. But when did the stock market become the barometer for what the Fed is going to do? Again, that is totally against the policies that were set. But of course, they've been able to branch out into more destruction. And of course, they will be wrong. And, one thing we know for a certainty is eventually something will change, because, again, you cannot make everything perfect. The markets themselves have to price themselves, and eventually they will. Just like we've seen going back all the way to Tulip Mania, and I'm sure before, okay, when they were trading rocks for whatever, okay, we get a correction, and there's going to be a correction. So we can try to artificially manipulate this market all we want. We can try to work on the dollar, but at the end of the day, eventually it will work itself out, and you cannot control every situation. And I think this is where one of the problems comes in, is we have, I think the Fed, first of all, as you know, I've said this many times, the Fed should be abolished, okay? I believe that the system itself would work just fine, okay? Because without the Fed, I don't think that you would have the banks always so going wildly lending. It might tighten up lending for a while, but at the end of the day, I think the banks, because they know the Fed is standing behind them, because they know they can get bailed out, don't care. And why would you? Okay. When you don't get penalized, if you own a restaurant and you go bust, okay, you're out of business, you're out of money, okay, unless you stole from everybody. But if you're a bank, okay, let me lend. I mean, we're already back into some 0% loans. We're already into, no money down, okay, buying housing again. So do we think that this is going to solve because we're continuing to keep rates low? This is one of the problems. Okay, but if you're a bank, what do you care? You know you're going to get bailed out by the Federal Reserve anyways. So why would you care of what we do here? Okay, that again is something that I find very, very scary and very frightening. Is that we think that it's going to work, and it just doesn't. It never has worked. It will not work now. We can do all the criticizing we want, and of course, there you have it. But again, you talk about some of the things that are going on that are affecting all this, and of course, I believe the number is 1/5 of millennials have debt that they'll never be able to buy a home. Okay. Now again, home ownership is obviously used to be one of the American dreams. Maybe not as much anymore, but certainly was an American dream. But at the end of the day, with the massive amounts of debt we have created, okay, we don't seem to want to take care of the debt. We want to continue to seem to add to it. All right. So I think that's becomes a much bigger problem. And I think what you're starting to see now is you're starting to see the numbers change. Okay. And what I mean by the numbers is the economic numbers that we're getting are not meeting expectations. Okay. Yet the markets don't seem to want to go down. Again, I'm not predicting a meltdown. As I've said, every week of this year, we are long and we're staying there for now, but I can start to see some warning signs here that when you watch it closely, okay, you can see that there's things that are changing. Okay. I think what you've seen a lot of is the fear of missing out rally, which the next will be get me the F out of this rally, okay, or get me the out. But I think what you've seen here, if you take a look at the volume in the markets, in the movement, you're seeing that this is not a well-supported rally. So the giddiness of all of the buyers is great. This is how it always happens. Okay. Now again, I'm not going to tell you when it's going to change, but we do see certainly there are a number of warning signs. I think we've just finished, okay, 10 weeks of making a higher high at the close. I don't think that's ever happened before. But we'll talk about that when we talk a little bit more about markets. But I think that, when you look at ISM manufacturing, which is a real number, that's a private number. That is not a government number. Okay. So manufacturing is down. Okay. I think that, you're starting to see a lot of changes, from an economic standpoint. We saw retail sales down. We saw over 465 retail stores close in a 48-hour period. Penny's and Macy's and some of the others that are closing stores. What happens to those jobs of those people that were working there? Now, again, there's still employment out there. Okay, so again, I'm not worried about that, and I see some good things in the economy, but I see a lot of concerns that we continue to ignore. Based on that the stock market is going up every day, and I think this is one of the things when you watch a market. These are the things you watch for. But at the end, I mean, the Canadian dollar got hammered, okay, because their GDP is brutal, okay, and oil is starting to, slide a little bit. Now, again, it's still up here near that near-term top of 58, but it's starting to slide a little bit. But again, there's so many things out there that we totally ignore, that we don't even think about. I mean, how about farm prices, delinquencies at 9-year highs, okay? Now, again, if we're in such a boom time, okay, why are farm delinquency at 9-year highs, okay? Now, again, many will out there will blame the trade wars, and I will continue to say that it's not the trade wars, it's not the tariffs, okay? I believe the tariffs are just an excuse for retailers like Walmart and all the big Chinese manufacturers to be able to raise their prices. I mean, I look now again, we've seen some breakdown recently, but I look and I say there wasn't much of a difference, and I do think that a solution has been priced in, but we'll see how that plays out. And we'll talk about more on that in our commentary. But again, if the economy is booming, okay, which means we're probably eating more, we're probably eating better, why are farm prices? And because that's another story. Because of the cheap money, it allowed big corporate farming to force the price of land higher to really try to cut out the little guy, okay, which is typical, okay. Again, this happens in every industry, and again, that's where when you need to be, when you're competing and you don't have the money, okay, it's a lot harder to compete against the big guys because they can actually work at a loss for a period of time while they're putting you out of business, okay. But that is something that should be a concern, and I think another big concern is what they call the Baltic Dry Index. That is the rate of which raw commodities are being shipped, okay. That is falling to its lowest levels, okay. Now, again, that by itself means nothing. All of these things by themselves don't mean one thing, but you start to combine them. And what you're starting to see is a potential problem. Okay. Now, again, I'm not ringing the fear bell. I'm not telling you chicken little, the sky is falling. What I'm saying is these are things that you can't ignore forever. And at some point, there may be something to pay from here. There may be a problem here. I mean, you're already seeing, companies trying to cut some other costs as well. Okay. Which is always a warning sign. Okay. If we were truly in prosperous times, okay, then there would be more reasons to be happy. But now you've got, for example, Kroger is going to start banning the use of Visa cards. Now, I said this on this show, okay, out of about 6 or 7 months ago, that the credit card companies were going to start to get into some trouble. Why? Because their fees are too much, and you're going to start to see people force either cash only or the credit card companies are going to have to compete with their rates for clearing all these fees. It's as simple as that. Okay. When you're clearing millions and billions of dollars, it's a lot of money to pay out. And I know there's some stores in my area that don't take any credit cards. And these are not small stores. I mean, there's a 250,000 square foot store that takes no credit cards. Okay. They take either debit, okay, check, or cash. Now, again, that's kind of counter to where we are in the general society, but I think you're starting to see that companies are tired of getting raked over the coals for these ridiculously high fees, okay? And I think that's where the competition is. Now, again, they built those fees based on all the perks they want to get. You didn't think the mileage perks and the other perks that you get, from all these great companies, you see all the advertising all the time, was just from the goodness of their heart. That goes back, that gets charged back to the retailer. So, and then it gets charged back to you. But in the meantime, they're getting fed up with it. And I think that's just another warning sign, another shot across the bow that we're seeing here. And again, I think it's something to take note of. Again, we'll talk about it when we get back from the break. This is Bubba's Bottom Line, Todd Bubba Horwitz, and always great to be here with you. And I want to remind you, okay, if you, I just redid the hedging and the futures webinars. If you'd like to get a copy of those recordings, just email me at bubba@bubbatrading.com. I'll be happy to send them to you. They're free. We had a great way of showing how to use stock and create synthetic stock in the hedging. So certainly, if you want to email me, that great. And don't forget about my friend Joey Foreman over at the Elite Promotions. If you're looking for some premium items, some sweatshirts, coffee mugs, pens, whatever it is, just go ahead and call him at 847-704-7120, and it's Joey Foreman, Elite Promotions. And in the meantime, don't forget about our high school program at Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. We're going to get back to the show right here. Welcome back to Bubba's Bottom Line, Todd Bubba Horwitz. And of course, last week, as I mentioned earlier, we're basically this year, if we were bowling, we'd be 2 weeks away from a perfect game, right? Up every week. We never go down anymore. Nobody cares. Okay. The markets continue to go up. The volume continues to go down. Volatility continues to get crushed. And as they say in the old world of trading, complacency is the architecture of our downfall. And certainly, again, we are not fighting it. We have stayed long the entire time. All of our models continue to be long, but there are many, many warning signs that are starting to show. And the first thing is that we continue to get crushed in volatility. That's number one. Number two, we are every bit of bad news is totally ignored. Okay. Now again, I'm not a guy that trades on news, so I don't want you to think that I'm changing my style. But typically, okay, when the markets want to go up, bad news pauses the markets. Good news explodes them higher. When the markets want to go down, it's the exact opposite. And I think we're starting to see way too much bad news, which should lead to a cause and effect of a market sell-off. Now again, we're not getting out until we get taken out, okay? And we won't get taken out until the algorithms change to the downside. So again, let's be clear there. I'm saying to you that we've been long, we're staying long, but I'm a little bit more concerned now based on action, based on the lack of volume, based on everything else that's going on, okay? I think that there's a good reason to believe the very tight, narrow ranges, the lack of price movement in the market. Again, those are things that are important, especially if you're a trader. Okay, if you're an investor, it shouldn't matter one way or the other. But if you're a trader, very tight price movement makes it even more of a challenge. We need bigger swings intraday to take advantage of. But we saw last week, we called gold 1350. We got the 1349.80 about 10 days ago. Bang, we came down. We said 1320. If that doesn't hold, 1310, and then that, if not that, then it's time to get out, and we close down in the 1290 level. Okay. Now again, I think we wrote and entered a short trade in gold on Friday because you could see the action. That's one of the things about reading the technicals. I think that that's what you're looking for. Okay. Now again, I don't say that the new bull market is over in gold. I just think we're going lower for a little bit here, and we'll see how it plays out. Bonds, after pushing up and torturing us, they never got to our takeout spot, and now they've fallen apart and they've fallen hard. Now it'll be interesting to see how they open tonight, okay, because of the rift over the weekend with Powell and Trump, but we'll talk about in our commentary later. But at the end of the day, okay, I think that they continue to go lower. I think that you're quietly seeing rates go higher again. We're quietly seeing the 30-year back over 3%. We're seeing the yield curve start to continue to invert at the lower range. So again, I think that that's something that we should be watching for. Oil, tried to push up to 58, fell, now didn't get clobbered. I think that you're probably looking, 55 as a potential stopping point for this current sell. But I think 58 is the key level that will continue to stay short against that 58. And I do expect us to get back into the 40s. Okay. And I still expect most likely a print in the high 30s at some point this year. Now we'll see. I can certainly change if the reasons why I think that change, I will change, of course. But again, I think you have to understand that how the markets actually function. I think that that's where we talk about, market functionality and how it works. And I think that's one thing that most don't understand is how the actual markets work and the supposed price discovery model and how we're supposed to see it. But again, looking at the market footprints is very important because that will give you a general idea of what's going to happen next. Now, we've seen a very rough week in grains last week. In fact, wheat has broken down a couple of weeks ago. Corn broke down last week, okay, and broke hard through support. It's a little bit scarier. Now, again, I think that 370's got a hold. Now, on Friday, they got down, I think 366 was the low, and that's May corn. I think they have to hold, the 370 level, and I did make it back. We had a kind of a dramatic shift on Friday as corn, wheat, and soybeans were getting pounded. Okay, all of a sudden, corn turned around a little bit and got slightly positive, and wheat was down about 12 cents. And the next thing you knew, it had gotten all the way back to unchanged and up a little bit. Now, it did close down a couple of cents, and corn did close back above 370. So soybeans held the support at 910. Okay, they got lower than that, but they came back and closed above it. Very important. Corn held 370. Important. Wheat is still now, again, wheat's in a little bit of trouble here, but I think you're probably somewhere near the lows, and that's what we'd be looking for. We're still holding grains. We're still buyers of grains. Again, it can be torturous, but again, these are now, they've changed from straight technical trades to trades that are now what I call as value, okay? Unless we're going to stop eating, I don't think there's a heck of a lot of room on the downside. So I think when you look at the risk-reward model, there's money to be made on the upside from here and very little to lose on the downside. And we'll see how it plays out. In the meantime, the hog markets, they look to have found a bottom. Again, we're not jumping in. We're not crazy in love to get in here, but we do think they have found the bottom levels here. So we'll continue to watch there. Live cattle or fat cattle continues to make new highs. It's got probably the cleanest, the purest chart of all trades everywhere. Continues to charge higher. Now, it would be no surprise to see a small pullback this week, down to about 128, 129, because it just escaped a little bit, but the trend itself is just, you couldn't draw it any better from a technical standpoint. And of course, feeder cattle remains in that bouncy range without much going on. I think you're looking at copper. Okay, they're now starting to talk about copper. Copper's had a hell of a run to the upside, and now it's starting to become a lot more mainstream talk. You don't hear much about copper, and then all of a sudden now we're, Dr. Copper's back. The markets are going up. This could very well be. Now again, we're not predicting a top here, but this could be very well running near the end. But I think one of the questions I want to ask you is simply this. Okay, I've said from day one that I believe that the China trade deal is going to be settled. Okay, I believe the equity markets have believed that all the time as well. Why else would be up the last 10 weeks? Okay, why else would we have that V-shaped recovery from Christmas Eve? Okay, but the real question here is, if I'm right, okay, and if the equity markets are right, why are the commodity markets getting hammered? Okay, I mean, the commodity market should be a benefactor of all this information, not underwater. And they have been, I mean, you take a look pretty much across the board from, as we said last week, the grains, okay, gold all of a sudden, oil all of a sudden. So there's a lot of things and other commodities throughout, okay? So if the deal is going to be done, we have a divergence between different types of markets, okay? Now, of course, the companies would stand to make gains, through the deal, okay? And of course, grains and commodities should benefit as well, but for some reason, they are not benefiting. So I'm concerned and curious as to what's going on here, because we've seen the movement. Now, again, I think that when it does settle, okay, when the trade wars do settle, which I still believe that they will, I think you might see an initial pop to the market, but then of course I think you'll see it fall right back down. Okay, again, I think we're getting very close to the tops. So I think there's a lot. Again, there's a lot of things to see here. I think that mortgage serious delinquencies are the highest in years now again. So again, we're starting to see the same thing we've been talking about, the good old debt program. And I think one warning I want to give out to all of you is I think you have to be very careful this time of year of the tax scammers. They're out there. If you get something from the IRS, it better come in the mail. Okay, the IRS is not emailing you or calling you. Typically, they're coming to the mail. So don't get scammed by these people. They're out there. They're laying for you. They're looking for you. And of course, with technology, they can get there all that much faster. So I just want you to be aware and concerned because I think that's one of the issues that we can see right now. And I think the last thing is it looks like it's potentially the final nail or the final death of the trading floors as J.P. Morgan pulled out their agricultural brokers, okay, which indicates there's rumors around that the floors will be closing at the end of 19. Okay, the last thing that kept the floors open was the options because of the complication of some of the spreads. But I think they have now. It looks like they have now resolved that, and I think this may be, as they say, the final curtain. This is Bubba's Bottom Line. Todd Bubba Horowitz. We will be right back with more after the break. Hey all, listen, I just did a couple of great webinars, hedging and futures. If you'd like to get a copy of those for free, okay, I'll be happy to send them to you. Just email me at bubba@bubbatrading.com. That's bubba@bubbatrading.com. And of course, if you want to check out my buddy's promotional items, Joey Foreman over at the Elite Promotions, give him a call at 847-704-7120. Certainly, again, he does sweatshirts and all the other good stuff. And if you need something great, he's a great guy. One of my closest friends. If not, hey, you check it out and see what you need. In the meantime, also don't forget about our high school program, Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. Let's get back to Bubba's Bottom Line. Welcome back to Bubba's Bottom Line. Todd Bubba Horowitz, and of course, I always have my little commentary. Excuse me. To go and of course this goes into as we often talk about, and I kind of alluded to some of it today, but this combination of the barking at Chair Powell at the Federal Reserve. Look, again, I think the Fed I don't think the Fed was ever worthless, or it was ever worth anything. Excuse me. Okay, I don't think that they do a good job. I think that they have no common sense, and they do not use what's actually happening out there. They use these very high grade, models that are built for what's supposed to happen. Now, we all know that what's supposed to happen does not always happen, right? We have to be able to have some common sense and be able to work on our own at the right time. I do not like the fact that the president is barking at Powell either, though. I think that we can't continue to fuel a artificial market and an artificial rally. Although we continue to say no inflation, seems to me I'm paying a hell of a lot more, and I got to make a hell of a lot more money than I used to have to make to live the same lifestyle. Okay, so to me, I think that the markets were meant to be free, and if we let them be free, and we stop having the Powell put, or the bailing out of other things, I think we would find that we might be a little bit better off. I think this Keynesian view of print is ridiculous. Again, I'm not concerned about the Fed, and their tightening and unwinding their balance sheet. I mean, again, they own the bonds. They could just let them expire and carry them to maturity. Okay, so whatever they're doing there, I don't know. All I know is that we have $22 trillion in debt from a national deficit, and we have the Fed has created $4.5 trillion that went to nowhere. It's like my son went to Hawaii, and all I got was this stupid T-shirt. Well, the Fed spent $4.5 trillion, and we got nothing. Okay, basically. So again, I think it's high time that you let the free markets trade, because the free markets will trade and will discover the asset class prices. Now, again, obviously, there is some concern, and I can understand where the president's coming from because of the whack jobs on the left, okay, that want to go into all this free money and have the Fed print, $93 trillion for the Green Deal. Again, this is where you have to let the free markets take over. And of course, that goes back into also the trade deal, which, again, the trade deal only benefits the politicians and the lobbyists. Okay, ask most farmers. Okay, ask most people that are directly infected. This has not had the overall effect on what they're trying to do. What's had the effect is there's been bumper crops. Okay, there's been good supply. So again, you can't overcome good supply. It doesn't create a demand. And I think that's one of the big issues. And again, my bottom line comment is this: let's let free markets trade. Let's not have all this intervention. And maybe if we ended the Fed, we could start to see that. In the meantime, have a great weekend, everybody. This is Bubba's Bottom Line. Todd Bubba Horowitz. We'll see you back here tomorrow with Bubba's Daily Update. And of course, always with Sundays with Bubba's Bottom Line. Have a great day, everybody. Thanks so much. We'll see you later.